Hey guys, so the stock market has recovered quite significantly since the March 2020 crash, and many of the major indexes such as the S&P 500 have hit new all-time highs recently. Looking at some of the main indicators such as the PE ratio and the forward PE ratio, the market does appear to be quite frothy and potentially you could call it overpriced right now. For example, if we look at the forward PE ratio to look at the valuation of the S&P 500 index at the moment on average, the average forward PE ratio is 21.5, a valuation that hasn't reached this high since the dot-com bubble in 2001 and 2002. Despite this, there is absolutely no way to tell if and when there will be a market correction or even a full-out market crash. However, there will be many people wondering how they can potentially prepare for this to happen, if it does happen, and there might be some people looking for strategies that they could potentially act on to outperform the market if there is a dip in the future. So in this video today, I'll be taking a look at 5 different strategies that could be used to outperform the market if the broader stock market does crash in the future. Just quickly before we get started, I'd really appreciate it if you leave a like on the video if you do enjoy it and find it useful, as that does help out the channel an awful lot. Also be sure to subscribe if you want to see similar videos to this in the future, and apart from that, let's get right into it. So first of all, we've got building a cash position. So during a stock market crash, when all stocks are going down in value, it may suck to look at your portfolio to see how much it is down, but where there is a crisis, there is opportunity. Plummeting stock prices allows investors to pick up shares in high quality companies for a discount price. So if you are a long-term investor, it shouldn't matter about the price of the stocks that you own right now, and simply provides you with an opportunity to buy more. Historically, the stock market has never failed to recover from every crash that has ever happened, as can be seen by the indexes being at all-time highs or near all-time highs right now. So if you are investing for the long term, then this simply gives you a great opportunity to average into your current positions at a lower price or start entire new positions. Now, some investors do find it hard to keep a cash balance and end up putting all their new cash into the stock market straight away. Personally, I believe that it's more optimal to keep a decent amount of cash on the sidelines to take advantage of any deals that do arise if there is a market dip. There is no right or wrong answer for how much cash you should keep on the side, and different investors do have different preferences, but anywhere between 10 and 30% of your total portfolio is believed to be a reasonable amount of cash to keep on the side, and having less than 10% could mean that you can't really take proper advantage of any dip that does happen. With this being said, if you believe that the market is overvalued right now, then having a high percentage of cash could be a good option because it will allow you to spend heavy if discounted prices do arrive. So next up we have buy low beta and sell high beta stocks. So beta is the measure of a stock's volatility compared to the overall market, in many cases the S&P 500 index, which does have a beta of 1. Stocks that do have a beta of higher than 1 are more volatile and swing more than the market over time, meaning that they have a higher upside often, but on the flip side they do have more severe drops on the downside. And then stocks that have a beta of below 1 have lower volatility than the market and will therefore be more stable and experience less severe movements, whether that is higher or lower compared to the market. So every mainstream finance website does display a stock's beta value, so you don't need to calculate it yourself, and this makes it easy to identify which stocks in your portfolio have a high beta and which ones have a low beta, and then based on these values you can then adjust your portfolio accordingly depending on how much risk you want to have. Now if we just take a look at some high beta stocks and low beta stocks, you can see that companies like Wayfair, Square, AMD and Tesla are all examples of stocks that have a high beta. So for example, Tesla has a beta of 1.99. That means that typically Tesla will move twice as much as the overall market. So if the overall market goes up by 5%, then typically Tesla will move up by 10% at the same time. On the flip side, low beta stocks like Public Storage, Digital Realty Trust, Consolidated Edison and Next Era Energy, among others, are examples of stocks that have a low beta, and as you can see a lot of these stocks have 0.1 and 0.2 beta values as of right now, which means that they do move quite steadily. Now if we take a look at some big tech stocks as well, You can see that the beta values for big tech do tend to be in and around the 1 value. So big tech does tend to move with the market, and there's not too much variance between big tech and the broader market. But this is most likely because big tech does make up a large portion of the overall market. So the big tech stocks are a heavy weighting in the S&P 500, for example. So this means that typically big tech will move quite steadily with the market. So if you believe that there is going to be a stock market crash or a dip in the near future, then it does make sense to increase your allocation to low beta stocks and decrease your allocation to high beta stocks to account for this. Doing this will mean that you are likely to take less of a hit if there is a correction in the broad market and S&P 500. But on the flip side, if the market does continue to go up and there is no crash in the near future, then there is a strong chance that you could underperform the overall market. So next up we have shorting the market. So if readjusting your portfolio isn't enough and you want to take things a step further, then shorting the market or specific stocks could be an option for you. Now, shorting is when you borrow shares in a stock to sell to the market, allowing you to then buy back at some point in the future, hopefully for a lower price if you are successful. Shorting is an advanced trading strategy that carries extra risk with it and should only be carried out by experienced investors or traders who fully understand what they are doing. However, if done correctly, then you can make a lot of money during a market downturn. Shorting the entire market by shorting an index, such as SPY, could be a good option if you believe that the S&P 500 is overvalued and due a correction. Alternatively, shorting specific high beta stocks that are likely to drop more compared to the broader market could also be a good strategy if you're looking to short. Now, the problem with this strategy is not only is it very risky to do, but it is also extremely hard to time correctly, which means that you could end up waiting a long time for the market to drop while you have the open short position, which in the meantime will cost you a lot of money. So the next strategy is selling your stocks. So selling your stocks is a straightforward and easy strategy to make money in a market crash. If you do manage to sell your stocks at the top and then buy them back once the market has dropped in value, then you will make a decent amount of money by doing this. The problem with this strategy, similar to shorting the market, is it is impossible to tell when a market crash will happen, and selling your portfolio and sitting on the sidelines waiting for the crash to happen could mean that you miss out on a lot of gains, which will lose you money when you do eventually decide to buy back in. This is a strategy that is very hard to pull off effectively and one that I will never personally consider doing myself. Personally, I would much rather dollar cost average into the stocks that I like during a dip rather than trying to time the market. And then the final strategy today is investing in alternative assets. So historically, certain assets do tend to perform well when the stock market performs bad. Now, based on historical data, these assets could perform well during the next stock market downturn, whenever this does happen. Government bonds have always been known as a risk-off asset that outperforms equities during a market downturn. They are thought of as a safe haven, as there is little risk of default by the government. Now, global bonds returned 12% in 2008, a year that was bad for the stock market, and similarly, bonds also performed well in 2000, 2001 and 2002, returning above 8% for all 3 years. Gold is also an asset that is viewed as a safe haven and has historically performed well during a stock market downturn. Between November and March in 2008, the S&P 500 dropped by around 30% and then bottomed, while at the same time, gold did go up by around 30%. So as you can see, that is quite a contrast in the returns that you get from gold compared to the stock market if the stock market does drop in price. So based on this, increasing your allocation in assets like government bonds or gold could be a great way to hedge against a market crash. So that is all for today's video, guys. I really hope you did enjoy the video and found the strategies that I covered useful and potentially give you some ideas on hedging against a market crash in the future. Please bear in mind though that these strategies are just my own personal opinions and they are not guaranteed to be effective in the next crash that does happen. And also, I am not a financial advisor and this video is not financial advice. so you should definitely do your own research before you think about making any investment in the future. With that being said though guys, please remember to leave a like if you did enjoy the video. That does help out the channel a lot. Also be sure to subscribe if you want to see more videos similar to this in the future. Also remember to drop me a comment. Let me know what your favourite strategy is that I covered in the video. I'd be really interested to see. And apart from that guys, thanks a lot for watching.